Are we live yet?
Welcome everyone to this midday edition of Benzinga's PreMarket Prep. Spencer Israel here, joined by Joel Elconin, and we're on the line with a special guest here with us now, Gene Munster, managing partner at Loup Ventures. Gene, how's it going today?
You know, it's going okay. It's been pretty rocky with some of these big tech names more recently. And separately is we're based here in Minneapolis, getting ready for the Super Bowl. It's been quite a circus. So I guess the combination of the two, it's been a very special Friday.
All right. Do you have a pick in the Super Bowl there? I know you're a little disappointed. Your Vikings aren't in there, but and you know what a huge Michigan fan I am. So go ahead. Who you picking?
Well, love the underdogs, so I'm going to actually go against the grain here and take the Eagles. Okay. Got all the respect in the world for the Patriots, but if I'm making a bet on this one, I'm gonna take the vast underdog, the Eagles.
Okay, and if your bets are anything like your picks in the stock market, then I'm mortgaging the house on the Eagles. But just
I love it.
Just a few quick questions here before we go into the specifics of the earnings. And this is probably as good a day to ask this as ever. Do you short stocks at all, Gene?
I do not. In the future, I may, just based on some of this transition that's going on in terms of what's happening in auto and the future of energy, things like that. So, but historically, I have not.
Okay. And technicals, I know we've asked you this question before. I mean, how much you consider technicals when you're overlaying the fundamentals with them as far as making decisions? Is it a factor, non-factor? What's your take on that?
In our case, we're dealing with such disruptive tech, and our bets typically are a little bit longer term, kind of the 1, 2 to kind of 3, 4 year kind of time window. So in that case, the charts are not as helpful to us.
Okay. All right. Thanks for that answer. All right. Let's get into the big report here with Apple. To me, it kind of feels like it was doomed no matter what. I mean, the suppliers, the reports coming out, they were cutting the supply orders and everything. And it did get a nice bounce overnight in the overnight session, but just kind of seems like the sentiment's turned here a little bit. Specifics on what you liked and did not like in that report.
I didn't like the iPhone number in the December quarter. 77 million was below the 80 million from the street. Wasn't a fan of the guidance. They got it about 5% below the street for March. So this is a kind of a rare opportunity where they had a miss and a guide down. Now, this had been widely expected. We didn't expect this, but this had been widely expected by the street. And so you kind of could see why the stock reaction today is down 3%. It's not so bad. I think the bigger point, what really has started to turn the corner for us here, and this is again kind of a longer term, kind of a 1 to 3 year kind of perspective, but is this concept of the ecosystem that they have and understanding how vast it actually is. And let me just give you the quick overview of that. And Apple went heavy after this on their earnings call, but Tim Cook kicked off saying that they have 1.3 billion active devices, and an active device is used once a month. So that compares to Facebook at about 1.4 billion, obviously very different kind of a use case, but it gives you a sense of the scale that they have, the amount of usage that they have. So why is that important? Is because they have such vast reach and they're making more money selling to each of those. So the ASPs are going higher and they're selling services. And so the big picture here, Joel, is we're disappointed with the guidance, with the report, but we're still optimistic on this story based on a belief that investors are slowly going to change their perspective on the Apple story. Hardware always is going to be an important part of it. People are always going to have whisper numbers around the iPhone, but I think you are going to see more of this concept of hardware as a service, where it's a more predictable type of a hardware business with a higher multiple in the future.
And what about the comparables? Tech stock strategist Sean Udall says, in his opinion, that what moves the stocks, how they move on comparables. What do you see going forward for Apple in the upcoming quarters?
Well, the comps are easier in the March quarter. They talked about that they're going to have double-digit sell-through in March, and kind of this mid to single-digit growth for overall iPhone. But then the comps all of last year were kind of in this mid-single digits, so there's not a ton of variation in the comps. Where they start to get more difficult is going to be in 2019, and so if you fast forward, what are people going to be saying about Apple in the next 3 months? There's going to be a lot of talk about the cash distribution and how they're going to give money back to shareholders when they report the March quarter. But these comps are going to be in 2019 a bigger topic. But you're going to have that offset against more talk. And I apologize, don't shoot the messenger here, but there's going to be more talk about a larger screen iPhone in the fall. The reason why I apologize is we just got through with talking a lot about the iPhone 10 cycle for 2 years in anticipation of that. And then now we're already talking about the iPhone 11 cycle. But there's some credible chatter out of Asia about some builds around a larger screen iPhone, about 25% bigger. So to answer your question on the comps, is that negative conversation around comps in 2019 is going to be somewhat offset by some positive expectations that they can do well in 2019 based on this larger form factor iPhone.
When Steve Jobs passed away, the company had no debt. Tim Cook's been ringing up the debt here. Is that a concern to you, or should it be a concern to shareholders moving forward?
They're generating so much cash that I don't think it's a concern at all. We're talking about $60 billion a year in cash generation, so that should not be a concern. They have about $110 billion in debt. It's at about a 2% interest rate, just over 2% interest rate. So I don't think that this is a concern. I think that this is just a smart capital structure.
All right. So you're enjoying the sell-off today, a little bit of short-term pain for long-term gain. And we'll see here, traded down 522 at $162.52. Let's backtrack here to Facebook. Made the big call a couple weeks ago. Saying, hey, we're changing our format. They hit the stock into the upper 170s and then comes roaring back here. And any thoughts on the Facebook earnings call?
They saved the best part for kind of the middle of the earnings call, which is Sheryl Sandberg's comment that the impact of this change to newsfeed. This is the idea. Maybe even step back one half step here is that newsfeed right now uses in part stuff from your friends and in part stuff from third parties. What Facebook has decided is for our own well-being and our social health, they want to get Facebook back to its roots, which is connecting people with friends and family. And so what they're doing is de-emphasizing content in your newsfeed from third parties. Now, a lot of people look at that content and are entertained by it, but at night it's not necessarily maybe socially filling, so they want to kind of reduce that. And that obviously scares investors because less time spent, and they said there'll be less time spent, means less money potentially. And that's, I think, a reasonable assumption. But Sheryl Sandberg turned the conversation 180 when she said on the earnings call that less time spent doesn't necessarily mean that monetization goes down. And I want to quickly decode what she means when doesn't necessarily mean monetization goes down. Is that they've been doing testing of this cleaned up newsfeed in the U.S. And the U.S. is called about 15 to 20% of their total users. And they've noticed that the monetization actually has gone up when it comes to this cleaner newsfeed. But she can't say that that's going to be the case as they start to roll that out over the rest of the world. And so the big story here is that I think this cleaned up newsfeed, if you want to boil it down to one point, it's probably going to be good for monetization.
Gene, I got a quick question here. In your opinion, does Facebook care more about time spent on the platform at all, or I guess quality time, engaged time spent on the platform?
They believe about quality of time. They're not trying to game the system. Mark Zuckerberg talked about that on the call. He said that we're not here to try to increase the amount of time spent. We're trying to increase, as you said, Spencer, the quality of the engagements. And so that's their kind of North Star. And I credit them for taking a risk and kind of getting back to their roots.
One bright spot in the market today, Amazon. You just just been nailing this one for years. Hit a high of 14.98. Some of the only green I got on my screen here is Amazon here. One question from another guest that we had. He wants to know when Amazon's going to hit 2,000.
You know, it goes in step functions, and just like you're talking about the Apple setup, and we just kind of knew this was going to happen. I think Amazon's probably due for something similar. It's up 40% in the last 3 months. I mean, just some wicked growth here. So I think that the bigger picture, I don't know when it's going to hit 2,000 is the answer. But I do believe that this is going to be one of the biggest companies. I mean, if you look at, they're now 10% of the way from the market cap of Google, about $710 billion market cap for Amazon. Google's about $780 billion. Apple's about $830 billion, just to give you some perspective. So I think that they're going to continue to move down that road. I can't give you just a solid, we think it's in 6, 12, 18 months kind of a thing. But I think it's going to be a scissors or a kind of a jagged saw, but up and to the right for this story.
And quick comments on the report. Obviously, the street loves it. Can you find anything that you didn't like in that report?
That's the better way to approach this. Is what did we not like? We didn't like the conference call. They don't tell you anything on the conference call. That's a little bit frustrating. But the part that was most impressive is they grew 35% in the September quarter, the December quarter, and their midpoint of their guidance in March was for 35% revenue growth. Unprecedented. That's up 10% from what their revenue growth was a year or so ago. So they're continuing just to turn the screws down on the broader retail market. I think that this profitability, they showed a little bit more profitability than normal, but don't get fooled. That's not going to be a trend. They're still investing heavily in areas, and you're going to see them do more on content in the next year or two, which is going to be depressing some of the margins. And so as far to answer your question, what do we not like? Maybe the earnings call.
Okay. You've been sticking with this target call on them. And, if the stock got hit under $50, now trading $75, I mean, maybe when it was in the gutter, Whole Foods was kind of in the gutter too as well. You kind of stay. I know they're Minneapolis based and everything, but you sticking with that target. I mean, they got some cash to do acquisitions. You think it's going to be brick and mortar?
It just makes sense. And to quickly go through why it makes sense is the conventional wisdom is that everything is going to go online. At Loup Ventures, we don't believe that. And we've gone through and looked at each different retail category and kind of determined that longer term, 10, 20 years from now, 45% of what's bought is going to be bought in a brick and mortar retail store that you walk into. So there's still going to be a huge market. If Amazon wants to be a retailer, a dominant retailer over the long haul, they need to beef up what they're doing at brick and mortar. And so Target gives them more stores. It gives them a shared customer base, kind of a high-end customer base, and a company that also wants to innovate around technology. And so we're sticking with that. We have this prediction that's going to happen in 2018. We like to think of it as a 60 to 70% chance to give us some room. That's hard to predict when these things happen. But we feel really comfortable over the next 3 years that this will happen. So we kind of say that's a 90% chance that eventually these two meet up.
Yeah, bold call there. Let's move on to Google. Trading in the red here, 47 down $48, hanging out at 11.20. Obviously, Street a little unhappy or just not satisfied with the report. Your thoughts on Google's report?
I think this is probably your bargain shopping and this sell-off for the long term. We love Apple. If you're going to say which one to own between Apple and Google, we'd take Google over Apple for the long haul because it is just a more efficient business, and we think of them as the oxygen of the internet. So the reason why the sell-off happened was because they're spending more money for growth. It's the increase in their traffic acquisition costs. And that's been a theme over the last couple quarters, is that this has been surprising people on the upside, negative surprise in terms of the amount that they're spending on TAC. But I don't think that fundamentally changes the story. The dependence that we have on Google services and the opportunity that they have to go after new monetization, including maps. Think about how many times you use Google Maps. There's over 1 billion daily users of Maps, and they really don't make any money on that. But that's a big opportunity for them longer term. And most importantly is they're going heavy after AI. For the 5th consecutive quarter, their CEO kicked off his comments by saying Google is going to be an AI first company. And I think that that really lays the groundwork for an investor. If you really want to play the AI theme, Google's a great way to play it over the long haul.
Gene, what about that report yesterday from the Journal of a potential partnership between Google and Saudi Aramco? Thoughts on that?
It's give credit to Saudi for thinking about what's going to happen after a post gasoline engine world. But the basic idea here is Google Waymo, they want to go after autonomy and electric vehicles. And so what better person to partner with than somebody who's been a big supporter of the old world, the gas and oil world. I also think my other quick thought is, oil's doing better lately, but I just have a really hard time getting my head around a future that has as much oil consumption as we have today. We'll always have some use of oil for plastics and other derivatives, but as far as about half the oil consumptions for automotive, that piece I think is just going to slowly unwind over the next 20 years.
Sticking with your AI theme, when we had John before, you talked about iRobot, and I took my eye off it, and it got clobbered. I had a report shortly after we had a visit with you. Then it's made a nice rebound here. Any thoughts? I think they report later in the month here. Any thoughts on IRBT?
So they report next week, and Austin Bullock, who's on our team, goes through and looks at what the pricing is on a daily basis. And the big negative story on this is eventually there's going to be lower cost competitors. Many of you might know Shark Ninja, for example. You see them at Target all the time. But the theory is that they're going to start to chip away at iRobot's pricing. We haven't seen it as we've been measuring the pricing. We haven't seen it, which we think is a positive. The street is looking for 16% revenue growth for next year. They're probably going to guide in line with that. So don't look for any big upside, but this management team has a history of underpromising and overperforming. So we'd expect that over the next few quarters, that the actual growth rate is going to be very similar to what it's been over the last few quarters, which is closer to 20%. So no reason for any real action today and next week. But I think if you can take a perspective of owning something for 6 months, this is a good one to own.
All right, let me just shift away from stocks here for 1 second. I saw your piece on Bitcoin a little while back, and you were a little bit bearish, leaning on the short side on that. And I heeded your call. I sold the remaining of my holdings a little bit after that. Can you make, it's getting hit, it's been getting hit. Can you make any kind of a bullish thesis here for it? Or do you just think there's no way to value it fundamentally, and so the value just may be zero?
Near term, you might as well just roll some dice to try to figure out what the value, where Bitcoin is going to go, or any cryptocurrencies. I think that's the crypto piece to it. I think for a long term, so I don't have any recommendation. Don't have any idea what to do with it in the near term. But I think the longer term about what's going on blockchain and crypto, and fundamentally how they're changing this concept of a distributed ledger, which we can talk more about. But I think that is going to be a core underlying technology that we're all going to survive on. So Joel, to answer your question is, don't know what to do in near term. I think long term, I'm a believer in this.
Okay. Me too. I just kind of like the tech bubble in, 2001. A lot of companies blew up, but now 16, 17 years later, here we are, and some of those companies have come back. Some are gone, and you have some new leaders. Okay, let's move to the one we probably disagree on the most. Tesla. You were banging the door, the buy door when it was down there at 300 last time we were on. It's made a nice run to 350. The street just gives them, passes after passes on this, on the production numbers. Just give you your take here on Tesla and their upcoming report.
I just want to make one quick clarification. We have stories that we're more favorable on, and we don't have specific buy-sell recommendations, but Tesla is a story that we're definitely favorable on. And I want to kind of, the quick update there is that we still believe that they're going to work through this Model 3 production issues, and we're going to see a huge ramp in Model 3. And as those cars start to reach into the marketplace, we think that the light's going to go on, that this is a much better value for your dollar in terms of electric vehicles. So the space is getting crowded. We were at CES. My colleague Will Thompson was at the Detroit Auto Show, ran into the great people at Benzinga there too. And I think that you're going to see more competition, but I don't think that that is negative relative to what the units are. And then just today, the other piece of the Tesla business, the whole concept around renewable energy, they did announce a deal with Home Depot where they're going to be starting essentially stores within a store within a Home Depot, 800 of the 2,200 Home Depot stores. So they're going to be showing more of their the solar panels and the battery walls. And that's important just to get people up close to these products, because eventually for them to really change the world, they have to win people. And that's a unique strategy to do that, this Home Depot partnership.
All right, and just fundamental question here. I know we've gone back and forth on this, and I just the whole feasibility of driverless cars, no matter who's creating them. I'll just go to a scenario last night, where I go over my mother-in-law's house for dinner and we take our dog with us. I mean, is you going to have the same kind of convenience and drivers? I mean, how long is it going to take technology to catch up to accommodate people for their schedules and the way we live our lives? I mean, I'm still having a hard time grasping that concept. So I know that's kind of a little bit of a strange scenario, but that's what I'm thinking about is ease of travel. Any comments?
No, it's
on
the
that?
right question to ask, and we think that this transformation is going to take longer than people think and be bigger than people think. So when do people think this is going to happen? At CES, if you listen to NVIDIA, they say we're going to have self-driving fleets, and you listen to GM, self-driving fleets within 2 years. That to us seems optimistic. But I think so maybe it might be 4 years away. So I think that's kind of when the starting point. And then we probably start getting to a point where everyday consumers can go out and buy these in 5 to 7 years, something like that. But if we go through and look at our model, right now, 0% of cars that are sold are autonomous. We think in 10 years, it's going to be 2%. So it's going to take, just to put things into perspective. But then it kind of quickly ramps after that, when many cars and most cars will be autonomous. So you see this huge ramp kind of 10, 15 years out. And so what ends up happening, Joel, with your example is you see a family that has 2 cars. Essentially, they go down to 1 car. So you still would have a car that you can go and take your dog to go see your mother-in-law. But you probably would go to work in that 1 car that's an autonomous car. And then when you get dropped off at work, that car would return to home or potentially go and work for you, join a fleet. Tesla's talked about this. Have your car join the fleet and earn some money instead of being parked during the day. So that's kind of the way to think about it. 2-car households become 1 car, and 1-car households become 0.
All right, we've been on the line with Gene Munster. He is the managing partner at Loup Ventures, venture capitalist, former analyst at Piper Jaffray, talking Apple, Tesla, Amazon, Google, anything tech, you name it. Gene, thanks so much for the time. Really appreciate it.
Thank you, Joel, Spencer, and talk to you soon.
Thanks, Gene.
Bye-bye.